Let's start by all standing up. If everyone can stand up for a moment, I just want to level set and see who's in the room. So everyone stand. Awesome. So now if you currently do some type of impact investing, little way, big way, doesn't matter if you personally or if it's your family does impact investing, have a seat. No, because we just want to know who we're talking to so that we have a conversation that's engaging to everyone. Okay, so for you who haven't sat yet, if you're thinking of doing impact, you know what impact investing is, you're pretty clear on what it is to you, and you think you're going to start to do it within the next 12 to 18 months, have a seat. All right, well, the rest of you are who are most excited about actually being in the room because there's new recruits to bring in to thinking about it, so have a seat. But wait, we're not done yet, because lunch was long and it came with dessert and it came with chips. So everybody stand up again. One more time. Everybody up, everybody up. I can see you, I'm taller. Here we go, for once. All right, so if you are currently a student, have a seat. There you go, that's like at least a third of the room. If you are currently faculty and that's your primary job, have a seat. And then if you're an entrepreneur, have a seat. And then if you are a wealth advisor, asset manager, or something in that, have a seat. And then, okay, so what did I miss? Who else is in the room? Some people want to just yell out. What do you do? What do you guys do? Someone yell.
Work in industry, product sourcing.
Oh, there you go, industry. So very good. So if you're at a like Fortune 1000 type of company, let's say, have a seat. And then what? Database management. I like it. Anyone else? What else am I missing? Nonprofit organizations, absolutely. Thank you. Foundations, nonprofit organizations.
Okay,
anything? Yes. Publishing. Ooh. All right. Anyone who's got some author dreams of yours? I don't know what he does in publishing, but right here, front table, as much as it'll be fun to make a beeline for us, might want to look at that too. Publishing. So with that said, now we have a little bit of an idea of who's here. And I just want to start by introducing, actually I'm going to have the panelists introduce themselves. It should have been kind of obvious who we are, but it's not. So I'm Tami Kesselman. I'm your moderator for the next hour journey, 50 minutes. And next to me, we have Anna Raginskaya, which I had to look down so I didn't mess that one up, from Morgan Stanley. And we have Ghislain Gouraige, which I said correctly, from Goldman Sachs. And we have Abigail Pohlman from, oh, sorry, not from Goldman Sachs, from UBS. See, I knew that, from UBS. And then Abigail Pohlman from Goldman Sachs. And I'm going to just have you, without going into anything on impact, if you could just say what you do, because I'm excited about whoever put together this panel. We actually have 3 very different perspectives, not just by firm, but by where they are in their firm and what they're doing. So then that will give a lens to the rest of what we're talking about.
Sure. I'm part of a group called the Blue Rider Group. We are a part of Morgan Stanley's private wealth management division, and we actually focus on the art community. So our clients are museums, nonprofits in the arts, artist-related foundations, and families that are really involved in the art community.
And just to say, you don't actually necessarily do investing in art. It's just that your clients, that's their priority, but the investments are across.
Sure, yeah. We invest in the financial markets, but our clients are all kind of empathetic and involved in the art community.
Great.
So I'm with UBS in Coral Gables, South Florida. And we work with entrepreneurs who've had liquidity events and their families across the generations.
Excuse me. And I work in our ESG and impact investing strategy team, which is a group across our investment management division, so helping families, high net worth individuals, foundations, endowments, sovereign wealth funds, getting started with and building out market rate ESG and impact investing portfolios. And I apologize, I lost my voice this morning of all times. So.
But luckily, this sound guy has her back, so we're good. So with that, just to jump into it a little bit, why we're here, part of what we're talking about, and it's great to be doing this in a university setting, is, as many of you know, we're at this really exciting point in time where we have, from about 5 years ago, I guess, 5 to 10 years ago, over 30 years, $30 trillion changing hands intergenerationally. And it's $41 trillion over the next 40 years. And that also doesn't count, something else that we'll go into is money that's transferring hands from the patriarch to the matriarch as well, right? So that's another 30 trillion, I believe, on top of that. And why that's interesting and important is you have the kind of traditional patriarch wealth system that has gone on in this country for over a century, I think, until pretty recently we were talking about this, where money, very much like the UK, transferred hands, the money management relationship, transferred hands from the patriarch to the eldest son or sons for decades, for generations. But somehow in the last decade or so, has transferred hands more and more from the patriarch to the matriarch, because matriarchs, for a variety of reasons, live longer, right? Longer life expectancy, men often marry younger. So it's transferring hands from the patriarch to the matriarch, and then from either of them to the millennials. And why that's relevant is that men in general, stereotype, but that it holds, are much more the J.D. Rockefeller, I make my money here, and I can be very philanthropic, and I give my money there. And men are much better at compartmentalizing, right? I can make all my money here, and I can be equally generous and give it over there. But women tend to much more likely need to integrate, right? Synergize. So if I know the patriarch died from cancer, and I give money to cancer research, and I give money to endow a wing at a hospital, and I find out I'm in tobacco and fossil fuels in my mutual funds, I can't have my money work against itself. So that, how I bring that together. And then millennials, which is most of you, how many of you are not millennials? Oh, well, there we go. How many are younger than millennials? Let's go, because I think we have two different directions here. Okay, a couple, and then a lot that are older than millennials. But a lot of you see this cusp, right? The changing conversation, where millennials, writ large, have watched an inconvenient truth in junior high, right? So as millennials, for those of you who are, it's not about do I want to make money or breathe, it's kind of how do I do both. So with that being said, let's jump into it a little bit as far as what you've noticed in your company as, well, how much of your client base has transitioned or is starting to transition to millennials, and what changes that maybe has brought on at the company for changing demands? Kick us off.
Sure. So I'd say, we're still at the point where millennials maybe aren't necessarily the key decision maker, but I think that families are increasingly realizing that investment management is very complex, and you're seeing millennials being brought to the table a lot sooner in learning about both how the investment world works, but also being engaged in conversations around what a family's priorities are. I think you actually see it most commonly if a family has a foundation. Oftentimes the kids will be tasked with sort of steering the direction of that capital, and that I think is actually a really interesting place to start, because when you think about impact investing, I think a lot of the conversation actually comes out of a conversation around values alignment. And when you have a foundation, usually the values of that foundation are pretty explicit, so answering the question around how do you align investments with those values is an easier one to start with.
Nice.
I'd like to follow up on what was said. We find within our practice that most of the millennials are part of a larger family structure. And what we see is that compartmentalization, which used to sort of define how people invested. The patriarch would separate, as was mentioned earlier. Now the millennials are part of the conversation along with the matriarch. And so the style of investing is now reflective of families' values and family priorities. So there's really pressure on our industry as a whole to be able to have answers for those questions when they ask, well, why are we with this firm? It's in the headlines for doing bad things. And it can't just be because we get the highest return. So we're seeing that those values are seeping in, and they're sort of being part incorporated into an investment policy. And more of that is going to occur over time.
Yeah. At Goldman Sachs, we see, I mean, frankly, the firm itself, we are the majority of employees at our firm are now millennials. The majority of the folks that we're recruiting are not only millennials, but are saying they want to work in these industries. We get, we make this joke that 120% of millennials want to do impact investing. And the majority of them that we're hiring want to come and work for our team and work in this space. And so you have all of those factors. And then it's what we're seeing is the way that we're engaging that next generation of wealth. So if you are working with a patriarch or a matriarch or a family as a whole, and historically the children have been completely uninterested in being engaged whatsoever in thinking about the family's assets or thinking about the family's foundation, when you mentioned the fact that you can actually have a positive social or a positive environmental impact with those investable dollars, all of a sudden, sometimes something will blink, a light will flicker with them, and then you'll start to get them more engaged. They'll start to pay more attention. I mean, we recently got a bit of a toehold with a client's assets, the son's assets held away because they had no idea we were able to do this. And once they realized it something that they could even do in their portfolio, they all of a sudden became interested and wanted sort of a seat at the table, and now is emailing us every day asking, how do I get my portfolio 100% aligned? So.
I like that. And then that last line that you brought up about the fact that they're emailing you every day. So one other thing we see with millennials is that they want to learn differently and communicate differently, and are much more from studies that, like Accenture did a big study a couple years ago on the fact that millennials, even when it comes to financial acumen, want to do online programming, they want to do webinars and video, they want to do virtual meetings with their wealth advisor, as opposed to the patriarch who probably went in and met with them or did everything over a golf game, and are much more likely to go to online groups, to social media, than to go to just a wealth advisor, even if it's their own wealth advisor. So how has that impacted, or has that impacted how either you retain families or recruit new, as far as not when it's the whole family coming together, but when an event happens, so the patriarch is gone and the wealth is transferred? Is there a difference in your service offerings, or have you noticed any changes in how people want to communicate as it transfers to the next generation?
Why don't we start down there? So
Well, I would kind of go back to what Anna said, whereas I think we're still at this point where the key decision maker is not yet a millennial in most cases. So I don't think we've actually seen that shift take place. There are other changes that are taking place where we always joke now that we're actually a tech company, right? Like at the end of the day, the majority of our employees are not only millennials, but they also work in our tech department. So there's a lot coming around from that perspective, and you have the advancement of like the robo-advisors and that business, and people looking for more sort of plug-and-play solutions. But I don't think from an ESG and impact perspective, aside from them wanting to be involved and be more engaged and have more along the lines of the reporting and the tangible metrics and being able to feel and understand exactly what that impact is, they're not yet the core decision makers from my perspective so far.
So as an industry, we need to do a much better job of connecting the advisor for the family that has worked primarily with the patriarch with that next generation. As a consequence, there are a number of different programs that are being put on by firms to attract millennials and people of that next gen that, as Abigail said, are not quite the decision makers in the family, but soon will be. So if they're engaged early, and there are things that reach out to them that speak to their interests, and a number of our firms have conferences, have content that's directed towards that segment, it allows for a seamless transition. And again, what we hear back actually impacts the way we continue to approach the families and how we communicate with them in the future. So it's a dynamic process, and I think over time, more and more of those voices are being heard and are shifting the way that we approach our clients.
Yeah, I mean, I would say that content is very important. I think we're living in this age of like shareability and like viral information spreading. I think that Morgan Stanley as a firm puts a lot of effort into generating content that's topical, especially around impact-related issues, what's going on with climate change, highlighting stories of companies that are doing interesting things on the inside. I think that in general, millennials, I went to a play last night, and the central theme of this play basically explored like egoism versus altruism, like why we do what we do. Do we do things out of an inherent desire to be good, or because we're going to benefit somehow by doing a good action? And I think that impact investing touches on these themes, because I think when people do invest with impact, you're seeing people come out almost like as evangelists for this community and want to tell their peers that they're investing in this way, either because they're inherently good and they want to invest in this way, or if they want to appear to be good. I kind of don't care. I'm sort of a fan of more people investing this way across the board.
So whether it's for an Instagram moment or just because it's in their core being, it ends up with the same result.
Exactly.
I'll take what I can get right now.
And I like that your clients are in the art world, and you started with, I was at a play last night.
Put your money where
Which
your
is
mouth
where
is.
all good financial, but I like that. I'm going to start doing that more from my financial lens. That is probably part of what I'm missing in my holistic lens on things. And then one thing, actually, I'm going to jump ahead to something, Abigail, that you mentioned briefly, metrics, measuring, right? So what have you noticed? And I think for anyone who's in this space, we all know it's an evolving field, right? Like there's still a long way to go, but there's a long way that's already, a lot that's already happened. And what do each of you see? And everyone doesn't have to answer every question, but if someone wants to jump in, as far as, do you see a difference between millennials, whether it's that they're part of a family discussion now and coming to the table as a group, or as money starts to transfer, in their view of the importance of metrics or lack thereof, and what's being done, and is it about making sure that things are measurable? Is it about report outs? Is it about doing different types of investments? Or is it really not an issue yet because something that you brought up is that we're at the beginning of 30 years of transition, so we might be not even 10 years in, which means the vast majority of clients are still going to be patriarchs.
Right. So I guess the thing about metrics and in this space in general, so for those who may not know, right, so when we say ESG, we're talking about environmental, social, and governance factors, and there are a lot of firms out there who are providing metrics around ESG. So perhaps it's a score, right? You're going to score a certain company based on how they're performing from an environmental, social, and governance perspective. Our own research and the research of, frankly, a lot of folks is sort of evolving to this point of realizing that the concept of scoring a company based on disclosure alone does not necessarily result in any measurable financial outcome or better outperformance. So just because a company discloses that they have a diversity policy does not necessarily mean that their board is diverse. And therefore, actually having metrics that are material, so the materiality of the metrics, and what's actually relevant to that particular company and to the industry that they're in. So fossil fuels are relevant for most companies, but they're much more important for somebody in the energy business, a company, an airline, or a company in the energy business, than it is for perhaps maybe an e-commerce site that doesn't necessarily have a big footprint from an industrial perspective. So making sure that the metrics are measurable is really a key component when we're looking at this. And then the other thing is how do you actually measure the outcome, right? How do you measure the social and environmental outcome on an ongoing basis? Depending on the, I don't know how much we want to get into the spectrum of asset classes, but if you divided the financial markets into public and private, on the public side, it's obviously a lot more transparent, and on the private side, when you're making private investments, private direct investments into companies, you're not, the things that you're going to be measuring are going to be along the lines of, you want them to be, I should say, along the lines of, okay, well, how many additional students were reached with this technology? How many additional individuals were able to, access this healthcare plan? How many more, megawatts of energy were saved? Those types of things. So if what you're doing, it's sort of, at least from our perspective, it's a prerequisite for making an investment that we consider an impact investment would be, is there a way to have a tangible measurement of social or environment? If there isn't one, then it doesn't really fit the model of what we're looking for.
Great. Anything to add?
So I'll just jump in and add that if you have this dichotomy between the public markets where there are more consistent efforts to find what is adequate in terms of reporting to the direct private investments. So the clients that we have, the families we work with, tend to favor direct private investments, which give them the opportunity to have a greater say into what really you measure. So we had a conversation this week with a large client whose family is looking for something that's impactful in the med tech area. And the reason that they're doing this is because they want to be able to know that at the end of a year of a particular period, it isn't just that they got their return on equity, it's that this measuring how many children got to go to school, how many lives were impacted by this particular initiative or product, that's almost as important to the family as the financial metrics. So you start out by saying, well, what is important to you as you make this direct private investment, and how are you going to track if they're meeting the goals that you need to have met? And the more you're away from the private markets, the more the family or the investor has a greater say in that dialogue and can impact the outcome they want and use their personalized, customized way of measuring.
Yeah, I would agree that we're thinking about metrics in really client-centric ways, so figuring out what are those perhaps qualitative factors that families are trying to solve for, and how can we look at where they're investing and directly sort of trace the impact on those areas that they're most passionate about.
And then just really quickly on that before we move on, as far as metrics, so for things that are impact investment in a way that the lens that you see as like the truest form to what you're attempting to do you see impact investing separately in public equities and in direct as something that brings more value on the financial side, that tends to have better returns, that tends to be neutral, or that tends to have a little bit of a trade-off? And is it different in public versus direct?
So in our opinion, we don't think there's any trade-off to begin with. We think that word should frankly be stricken from the directory of this space. So we think, our entire business is built around finding market rate of return investment portfolios, building market rate of return investment portfolios across public and private markets. So we think that there are, a lot of people have been burned, I think, if you were involved in this historically or you did it a while ago, I think historically it had been done in maybe well-intentioned but poorly executed fashion. So perhaps like negative screens, just fully chopping off a portion of the portfolio with no eye towards tracking error or any of the traditional financial metrics. Or perhaps, it was done in a very highly risky, direct way in the private markets, but it perhaps with a concessionary lens to it, or allowing for some sort of give up in return. And we just, at this point in time, view that those as two sort of extreme ends of the spectrum, and then there's a lot of tools in between that you can now use, and they're all very nuanced, but they allow you to access interesting opportunities across public and private markets that would allow you to have this environmental social return without having any type of give up. We sort of think of it as an extra lens, an extra oversight, as opposed to any sort of hindrance on your approach to investing, right? So somebody once asked a colleague of mine in a meeting, well, doesn't it feel like you're approaching investing with one hand tied behind your back? And her response was perfectly, actually, no, I think of it as we have a third hand, in fact. So we're looking at it, right? You're basically looking for managers, you're looking for companies and managers who are approaching investing in a way where they can think really thoughtfully about a changing world, right? How do they think really well about climate change? How do they think about changes to social policies and, frankly, what millennials and what younger generations are focused on, what folks are, valuing in companies and in corporate culture and corporate America?
Our research internally at UBS reflects the same thing that Abigail just said. You don't have to make a sacrifice of return if you're looking for ESG or impact investing. And in fact, you actually outperform slightly, at least the numbers that we've run over the past couple of years, if you're able to do that. So I think that's good news for you as investors, where you can do good and you can invest and not find you have to make a sacrifice.
I would just add that there is a place for concessionary investing, and for example, certain private foundations or even individuals or philanthropy you could think of as concessionary investing. So there is a place for it, but what I think a lot of us up here are focused on are building out market rate investment portfolios.
Yeah, I'd say that impact investing kind of suffers from a branding issue, and part of that branding problem came from those examples of kind of extremist, either divestment or, on the flip side, let's build solar panels in Tanzania with a manager who's never done this before.
Exactly.
And I think that especially when you think about that intergenerational question, when you reframe it as risk management, okay, we're going to look at a company whose governance team is the most solid, or who is aware that climate change is going to completely displace where the business is currently located. Taking that lens of risk management, I think, is a lot easier to explain to like an older generation, hey, we're trying to be safe here, versus perhaps we're chasing returns with like a frontier technology or something like that.
Yeah, absolutely. And with that, do you see as money transitions to impact-aligned portfolios, especially on the impact themes, do you see that there's capital exiting any particular sectors or entering other sectors? Like, have you noticed any flow of capital, and probably more on the direct side, but even on the public equity side, where there are, whether it's divestment campaigns or other things going on?
Sure. So we look at impact investing basically across asset classes. I'd say we're especially strong actually in the public markets, and I personally am like very interested in the public markets because almost everyone is somehow invested in them. Like if you have a 401k plan, you're invested in the public markets. And this question of capital coming in or out, like say you take a view that you don't want to be invested in oil. Well, you could pull your money out of oil and gas companies, and then you run this risk of tracking error, and perhaps you're going to underperform the market and you'll be upset about it. Or alternatively, what we're seeing clients do is look at best-in-class companies within sectors that might have a problematic track record. So you're saying, okay, well, I will invest in oil and gas, but I'm going to invest in the company that has the best practices around like building out a renewables strategy, or has the most solid record on maintaining facilities in a way that's not going to impact the environment. And actually, when you're invested in a fund, and that fund might represent hundreds of millions of dollars of investor capital, company management teams will listen to investors in that context where their voice is amplified. So we've actually seen a lot of really positive shareholder advocacy outcomes for investors in pushing large public companies into directions that are more sustainable.
And then with that, can you touch on something? So Larry Fink, who hopefully many of you know is the CEO of BlackRock, wrote a pretty somehow earth-shattering letter to CEOs last year, right? In 2017, putting them on notice. So if you haven't seen it, you should Google it. It's pretty long. But basically saying they are the largest asset owner of most Fortune 1000 companies.
Right.
And with their $6.3 trillion in assets under management, said to all CEOs of all companies they're invested in, we expect you to be good stewards of your communities and of society, and we will equally start to look at that, and for a variety of other reasons, committed to starting to do shareholder activism, where up until 2017, they voted with management 100% of the time in every proxy fight. They did a 180 reversal and are now actually active stewards and joining proxy campaigns. So with that, have you noticed anything different after that letter came out internally in your firm, or how you look at things, or how other investors or companies that you each come from pretty big firms that have access to senior management of some of the bigger companies?
So I don't think necessarily anything changed at our company as a result of the letter, because we were sort of already on that same page. You know, back to what Anna was saying, when we, you know, the idea of getting out of or divesting something, we view more as, frankly, an act of free speech, right? There's not necessarily an impact mechanism taking place or transpiring, right? If you're going to sell, if I'm going to sell one share and Tami's going to buy that's the same share of that company, there's no, we're not capitalizing on any impact metric there. So with the families and the clients we work with, we often find that, you know, spending a lot of time in the ideology of what to screen out of is a place where a lot of people get stuck, as opposed to most people can agree on what to invest into. So spending a little bit less time on how do I get out of certain things that I find questionable, and spend more time thinking about what positive things could we be doing with this capital, with new capital we're deploying every year into perhaps private investments, or as we look to rebalance the portfolio, fire a manager and invest in a new manager, et cetera. So, I mean, I think if we were going to say broadly what themes people are, you know, are flowing their money out of, if they did choose to divest from something, it tends to be, you know, the energy sector. It tends to be weapons, particularly in the last, I'd say, year or two, around small arms manufacturing and retailing, you know, tobacco, alcohol, those types of things. And then investing into, we kind of, when we look at the world of ESG and impact, we divide everything into the, you know, we think about it as people and everything else as planet, right? So you can kind of, most of the things that people are focused on from a social and environmental perspective kind of focus, you know, go into one of those two things, and then the governance sort of falls across it. And so usually people are investing into something that they're really focused on from either a people or a planet perspective.
So the letter itself didn't necessarily change how individual wealth management firms, you know, approach their clients, but it does signal a paradigm shift in the types of conversations that we as investors are going to have in terms of what companies we want to buy, what constitutes a good company. And it's not just that the numbers are consistent, that you're getting returns for shareholders, it's also the impact on society. And I think more managements than not are receptive to that message. And Larry Fink's letter reflects the fact that the investor community is also paying attention. So we're seeing this is where the puck is going. And it's encouraging for those of us who think about these issues on a daily basis that now becomes part of the conversation for most of us as investors, whereas before 3 years, 5 years ago, it just wasn't even a concern.
I mean, if any of you were here at the panel this morning on private equity, I mean, there's firms that you kind of never thought as taking a stand on impact, launching impact funds. I mean, it's really like increasingly becoming mainstream. And like back to the millennial question, we did a survey and we found that 86% of millennials were interested in impact investing. So that's a very high percentage.
And then, so with that, kind of, I want to just take a moment to go into the weeds a little bit before we open it up to questions. And we had talked about impact measurement. So is there anything, like what does your company do right now on the reporting side? Like, let's get a little bit more gritty and into the weeds, because we've been talking kind of high level. So whether it's across the board or in specific type of asset classes or with specific themes of investment, what are you doing on the reporting side that maybe weren't 5 or 10 years ago?
So for us, a lot of the reporting is taking place on the private market side. So we define the spectrum that we think of, and I think most of our firms kind of view the world this way, right? If you think about the spectrum of solutions here, you've got, on the one hand, you've got alignment, so you think around some sort of, maybe what historically what's been thought about as negative screen, but maybe in a more sophisticated, risk-managed fashion, you know, but essentially owning an index, but excluding things out that you're not necessarily as, you know, that are not aligned with your values. The reporting there is really around tracking your benchmark and making sure that you're going to be tracking your benchmark as much as possible, and you have the lowest tracking error as possible. So that tends to be more of a, from our perspective, a traditional benchmarking exercise. In the middle, you have more of a proactive, what we call ESG integration. So you're proactively incorporating environmental, social, and governance factors in the investment manager's core investment process and thesis. So it's something that they're overlaying into every decision that they're making. The reporting there, I would say, is a little bit more of a challenge and less transparent. Where we see the most interesting reporting taking place is then on the third sort of bucket would be the private asset side, what we think of as impact investing, where you're making direct, you're looking basically for business models for companies where their core, the way that they are successful is by having a positive and social and environmental impact. It's not a side effect, it's actually the exact goal of the company, but at the same time having a financial return. So that was what I was mentioning earlier, where when we're looking to make those investments, we're making sure that there is something that's measurable. So we produce an annual impact report for a group. We have a fund of funds, a fund of our top 6 to 8 private impact market investments every year, and we create an annual impact report as a result that we can send to clients. It's got a lot of metrics around each of the underlying portfolio companies, how you think about how we're measuring them, how many, depending on the technology or depending on the company, the metrics are going to be different, and so outline what those are and making sure that it's very clear that that's how we're tracking some of the successes.
And then for each of you, do you look at, does anyone not know what are the UN Sustainable Development Goals? Right, okay, so there's a couple people. So there's the UN in 2015, to make a very long story very short. The world came together in 2000 and started the Millennium Development Goals, but without much thought to it. And then they learned their lesson, and those were 15-year goals. So in 2015, with a lot more input from hundreds of millions of people around the world through trade unions, through all sorts of major groups, women, children, environmental activists, came up with 17 goals. And amazingly, for the first time maybe in the history of the planet, because of the inputting process that included so many thought leaders and so many asset owners, including, there was a very big commitment by the International Chamber of Commerce and all. The SDGs, when they were voted in 2015, the first ones to run with it and really do something and look at how does this impact me were corporations, who actually had a bigger uptake. And if you look, you'll be amazed how many companies you can Google and put the word SDG, and they have something, either an impact report or something online or something else that they're talking about in their framing, even more than nonprofits do. And nonprofits are catching up. Yeah. But with that, do you use the SDGs as a frame at all, and does that play in?
So one of the things that we've done as a firm is begun to develop ESG-specific model allocations that span the risk spectrum from conservative, moderate to aggressive. This is kind of new, but we're going to be seeing over time is you can track your specific investment versus that model, how that model is done, and do all the back testing, and be able to really get a sense as to how that's going. So from a standpoint of where you see the performance, how you report that, here's a tool that says if your flavor is conservative, here's how our model did, and here's how you did versus the model, and you get a sense for how this investment, which allows us to understand, can you outperform using ESG portfolio than a standard portfolio doesn't even care about social impact investing?
Yeah, I mean, I'd say we're taking it sort of one step further, where we're using the SDGs and individual investors sort of issue areas, if they fall outside of the SDGs, to both customize the portfolios and customize the reporting to the extent that their portfolio is meeting those goals. I love the SDGs. The other point I would say is, one thing that's really kind of inspiring to look at with what's going on today is, I think, even if legislatively things feel like they're a mess, I think we're really seeing the private sector step up and try to address a lot of these challenges, which is where impact investing becomes very exciting. It's like, how do you empower companies doing the right thing to go forward and solve those problems? So
that's awesome. And I think that that's a good point from which to break and take a couple questions. Unless we've answered everything for everyone, of course. Do we have people come up here? Oh, great.
Hello, my name's Ruby Pittman, and I also saw something artistic last night. The Barnard dance group, including Columbia students, they're at New York Live Arts in Chelsea, and I got to see them last night. I go to NYU, but hey. Nice. Hey, it was really good dance, and the choreographers, it was really great choreography.
All are welcome here.
Yeah. My question's actually for you, Anna.
Yep.
Anna? Okay. So could you talk more about Blue Rider Group's strategy art advisory? And then beyond that, your advice in making impact within the arts that can promote self-sufficiency for arts organizations. Because I'm sure there are foundations here that invest in the arts, but how can we invest in the arts, and what advice would you have from your research or the discovery part of Blue Rider Group's process, and what advice would you have for, say, like anyone from Millennials to like big foundation heads that may be here in researching about the arts and promoting self-sufficiency?
Sure.
Great.
Thank you.
Multi-part question, so I'll try to like address the parts that I can address. So I'd say, yes, we focus on the art community. I think that, you know, our core business is investment management. So oftentimes, like, our engagement with these clients is, say, it's a museum, they have an endowment, that endowment needs to be invested so the museum can do programming, et cetera, we like handle the money part. But because a lot of my team has a background in the art community, we also sort of bring in other helpful contacts. We try to help them raise awareness for their mission. I would say with investing in the creative economy is actually an interesting concept. So for example, we work with fixed income managers who are lending money to the development of housing projects. And those housing projects might have on-site arts programming for the residents. And they'll also do a lot of other sort of positive social engagement, like they'll have after-school tutoring for kids that live there. They might have like employment training for the residents. A lot of people are talking about opportunity zones right now. The recent tax legislation that came out basically is rewarding investors for putting money in certain parts of the country that need more development dollars flowing in. And
Like Amazon in Queens?
maybe not so much like Amazon in Queens, but there's like tens of thousands of these designated zones around the country, and a lot of people are talking about the impact this will actually have on the creative economy, defined pretty broadly. I mean, that includes breweries, it includes restaurants, it includes like all that local flavor that makes a city a city. So I think that that is a way that you can see really investment dollars flowing into the arts in kind of a broad way. I mean, we talk to arts organizations a lot about just values alignment again. I mean, if you're a museum and your mission is about diversity and inclusion and you're going out of your way to fund free programming on Saturdays for the local community, you should also be investing in companies that have good practices around maintaining a diverse workforce, et cetera.
And I think with that, it's not just domestic. A great person who speaks out pretty eloquently on this is Ron Cordes. And the Cordes Foundation spent a lot of their foundation money investing in artisans in Africa from early 2000s, and after 2008, as he tells it, like that was, they were doing it to invest in for profit, but we're doing it really more philanthropically. Like they were okay with it being concessionary capital. And after 2008, when he looked at his core portfolio, as did everyone else, and it was down, he thought, oh God, and now like what's gonna happen over here, where they were pretty substantially invested. And of course, as he said, artisans in Africa had no idea that there was a housing crisis in the United States, right? So like it didn't impact that, and it actually was a great buffer. So there's ways to look at it where actually investing in arts and other non-correlated assets can be a huge advantage. Thank you.
Hello, Marion and Tiru. I was curious.
What's your background?
I currently work at a family foundation and we look for growth stage social enterprises in Africa. And one of the things I was just curious to know your opinion on is in terms of concessionary investing and the role that patient capital or just philanthropic capital plays when it invests in for-profits. In some ways, it feels like it's propping up or falsely propping up a business model that maybe will never grow, but I just wanted to know how you think about the role of philanthropic capital as it relates to for-profits.
So maybe I just want to rephrase to make sure I understand. So do you mean, just because your background, you said you're at a family foundation, so you're saying for a company like one of our companies having a philanthropic arm and that arm, or you're talking about private foundations having philanthropic dollars? Just want to make sure I'm understanding.
Or philanthropic foundations having investment dollars that they're allocating to for-profit companies.
I guess, any dollars that go to a for-profit that's solving a social issue but is legally set up as a for-profit.
Oh, I see. Right. So basically, let's say, like, you know, our boxed water is better, right? So, for example, they're a for-profit company. There may be, somebody up here earlier was talking about how they were a B Corp, right? A lot of these companies fall into that bucket of B Corps. So your question is around those types of companies where they're for-profits, but they're also looking to solve a social and environmental problem. I mean, from our perspective, that's kind of exactly what we're looking for. We view that as the sweet spot of being able to use capital markets to drive social and environmental change. So a way to be able to access and have an impact on these markets without having to look for government intervention all the time. So and when you have that for-profit model, they tend to be more resource efficient. They tend to be more, you know, I don't want to say capital efficient, but they tend to be able to provide services and get access to services that a nonprofit organization may not be able to. I don't think that they're out to replace the nonprofit model in any way or shape or form, but from our perspective, we view them as an important component in this space. And they tend to be the companies that we're looking for from a private market impact investment perspective, what we're looking to invest in explicitly, actually.
So I'd answer your question this way. So as a family foundation investing in for-profit companies, the types of investments you're likely to make are not going to be the traditional investments that have been solely focused on getting a 20% return on investment. Right. You're looking at the social entrepreneur and the ability to take that vision that the entrepreneur presents and allow them through patient capital, as you've described, meaning that you're going to withstand a number of down years, a number of cycles to get to an end. And that objective that you're striving to achieve isn't necessarily making that social entrepreneur a millionaire or billionaire. It's to transform the communities in which they operate. And that's a unique role that the philanthropic point of view as investing can impact and influence. And the degree of innovation that you can get from these young entrepreneurs who are sort of bursting with this energy, I think it's a great model. And to the extent that you can encourage others to think of it in that way and to use the family foundation money to go into that social entrepreneur sector, I think that's a home run, and more of it should happen. And in fact, when these people get to the next stage, the social entrepreneurs, they pay it back, they pay it forward, and I think there's a lot of benefit that comes from it.
And then do we have one more question? Yep, or two? We have two more, and then we'll wrap it up.
Hi, my name is Susan Madden, and I'm a nonprofit management consultant, but my question is actually fairly personal. Sorry, everybody, personal question.
All right, well then make it super fast.
Okay. I've been doing impact investing on my own, but I'm trying to encourage my husband to get involved in it. And he he sees it as Susan's little philanthropy. How can I encourage him to accept it more as a bigger practice and see the value of it?
Can I just say, I think that's an awesome question, and as much as you think it's personal, who else can relate to trying to get a loved one or someone else who has some of your assets under their management to get in line with you?
I would imagine dealing with families, it's probably a huge issue for you all.
So I think one of the answers that can convince your husband and others who sort of think that way is this is becoming mainstream. And we have a conference here, look at those who are in attendance. There's a great deal of interest in it. It's becoming part of and parcel of the decisions that corporations are making, public companies, private companies. You just can't escape it any longer. So if you're going to be an astute investor and you're going to ignore this trend, you're going to be the one left out and left behind, and opportunities to make more money will be sort of highlighted by those companies that are best of class within certain sectors. And if you ignore that, you're going to miss it. He needs to get on the train.
And also, I mean, the data is increasingly there.
Yeah.
Like, performance data is there, looking at sustainable funds versus non-sustainable funds. And again, we're either seeing no trade-off or outperformance because these funds are managing risk better. So if he's a numbers guy, just show him some numbers.
And that's what I always start with, because I work with a lot of family office CIOs, and some of them are like, I'm long, short, macro, and this is all bullshit, pardon my French. And my millennials, no joke, had a a CIO of a multi-billion-dollar family office say, if my millennials want to invest in impact, they can borrow against their trust and they can pay me back with interest. I'm like, that's an option. But so what I talked to him about, and it happens to be a Texas family, so I knew they had to be in oil. Well, most people are in oil. If you have a 401k, right, you're in oil. And so I talked to him about the cost curves of renewables, and it doesn't matter what's going on in the US or anywhere else. You look at what China's invested and how much the costs have come down and how competitive it is with fossil fuels. And there is not a person, not an economist out there that will tell you that every drop of oil in the ground right now is coming out at today's barrel price, even with the price having dropped. It's just not gonna happen. So stranded assets, and like how long do you wanna be holding that bag? When that write-down happens, is it gonna happen next year? No. In 2 years, probably not. But soon after that, do you wanna be holding that when you get the 50% write-down or more on all the stranded assets in the ground that are being valued at today's asset price? So just put it in like concrete terms.
The only other thing I'd say is also just, making the case for something just being a good investment. Say, listen, I'm going to bring to the table an investment for you to weigh in, and you look at it from the same financial metrics and due diligence that you would any other investment you're making from a conventional perspective. And if it passes muster, great, we invest. And if it doesn't, then we won't. I mean, doing this is, a lot of times, we get asked the question like, oh, well, do you have to give something up? Is there a trade-off? And, it's really no different. It's kind of like saying, well, are all active managers good? No, some are really good and some are bad. And so it's how do you find the best in class managers across the board? And so viewing it with the same lens and the same rigor and the same metrics he may be looking at any other investments, just keep bringing them to the table as just another good investment. Maybe even try take the labels away from it, right? Like rename it something else. Take the word impact out, and if it's still just a good investment, then invest in it.
Thank you. And then I think that brings us to our closing remarks, and us being at a university, I'd love to end with some homework. And so if you can answer this in two ways. For the 101s, the people just starting in impact investing, what their homework should be, and for the 301s, the ones who are pretty experienced and already in the space. A, what would you put on the reading list of like must read? And then B, is there a podcast? And then other ways to up level. So if you're at that 101 just starting, what's the fastest cheat sheet, Cliff Notes? Do they still have Cliff Notes? I don't know. Cliff Notes to up level, or if you're already pretty advanced, like what are you looking at is how you want to get even deeper in? Who wants to jump in?
I mean, I would start 101, I would just start to think about like what are the issues that are important to you? Like if you're out protesting like at the Women's March because you're upset with what's going on politically, well, think about, is there a way I can also invest in companies that are doing a great job providing goods and services to women? Reading. Our Institute for Sustainable Investing publishes great content. Just a plug. It's online. It's free. It's free. It's short and sweet and to the point. I like it a lot.
Cool. And from a 301, like advanced, like what are you looking at right now to up level yourself? Or listening to, or whatever it is.
I mean, I'm trying to follow the news. I think that you're seeing a lot of reports being put together by a lot of different agencies, governments, seeing like how that is amplifying throughout, seeing what my friends are saying online. That might not be a 301, but I think it is very important to have a pulse of what people care about.
So on the 301 level, I'd say focus on the direct private investments. That's a sort of a new area to go into, where the impact is really outsized by the investment that gets made. Maybe a little more risky, more illiquid, but that patient investor, that patient capital can benefit there. So sort of understand how you can take advantage of that investing to influence the themes that are important to you.
So I think I'm kind of a millennial in denial. I don't understand or listen to podcasts, so I don't really have a recommendation for you on that front. I don't even carry around headphones with me. From a 101 perspective, I mean, to the extent that you or somebody in your family has a small amount to invest, buy a share of something. Buy a share of a company, or that you think is, a socially or environmentally just company, or buy one of the multitudes of ETFs out there. I mean, we've launched some. I mean, lots of organizations have launched ETFs that are socially responsible, but that ownership mechanism where you actually own a share and you're getting reports around it, and you actually kind of can tangibly just one thing. It can be less than, it can be $50 worth, right? Which I understand is different for different folks in the room, but that I would say is the best way to kind of really get your arms around and kind of get the feel around doing the work. And then from a more advanced perspective, I mean, there's just so much, you know, whether it's Morgan Stanley, UBS, our own, you know, our own asset management business, publishing papers and research. There's so much reports out there. You can be inundated, but I would kind of encourage you to go to the source as opposed to sort of op-ed pieces when you're out looking.
And then I guess my last thing to end with is for those just starting out, The Impact. So theimpact.org, which was Justin Rockefeller, Liesl Pritzker, and Josh Cohen started. They have a lot of good 101 tutorials on the investing, I think both in public equities and private equities. Also Tonic, the T100 report, for those who are more advanced, want to see exactly what the state of the space is right now. And then from a daily read perspective, anything on Impact Alpha, which is pretty good at amalgamating all different stories from different places, as well as I think they have a podcast now too. And I think we'll leave it with that. So thank you, everybody. Thank you, guys.